All right, hope everyone's doing well. So I've been looking at recently, past kind of 24 hours, a lot at the micro futures contracts, and right now you can see I'm actually long. I bought this. I don't really care if you. It's a simulated trade. I bought the close of this bar right here. So I bought at 88.75, which is basically the close of this second bull bar. Let me see if I can kind of zoom in a little bit, make it a little easier to see. It's basically the close of that bar. Maybe a little bit higher. And I'm holding long. I think we're going to try to close the gap. We'll have a second leg up. Really, I'm more interested in kind of the overall pricing structure of the micro futures, which is why it's a simulated trade. Um, so needless to say, you can see there's my stop. Odds are you'll get a second leg. So I'm pretty sure we're going to close this gap. But what I've been really looking at, everybody knows, if you've been listening to Al, sorry about that. So yeah, the one thing Al's talked a lot about is the micro E-minis. And I think I know I haven't discussed it. I think it's a huge, very impactful thing for most, especially people starting out, because it lowers it makes it easier. Now if I look at the dollar yen, I'm not a huge fan of Forex, mainly because of this. I like 5-minute charts. However, this range is 55 to 35. This 20 pip range, not a lot of movement. But when I can look at markets like the ES, the micro E-minis, lots of movement. And this is the micro E-minis. I'm really, just because I'm kind of watching this trade, even though it's simulated, it's kind of fun just to try it out a little bit. But so anyways, so I'll talk from the perspective of the NASDAQ 100 micro E-mini, but I really mean the E-mini just in general. So obviously, if you think about at first you had the S&P futures, if I'm correct, which I'm nearly certain I am. Then you had, obviously those were extremely expensive a long time ago. Then the E-mini was born, made it less expensive. Now the E-minis, and still is expensive, so they're making something even less expensive. So the micro E-mini, if you hadn't heard of it, it's basically 10 ticks. I think my risk right here, I'm risking, I don't know, $30 total. I think I have like $15 profit, $15. So I think if I'm long right here, I think my profit's like $15 and my risk under my entry is 15. So I'm basically have like $30 of risk, including my open profit. So if you compare that to the NASDAQ, and I'm not sure, I'll have to check. I have not looked much into the NASDAQ. I'm not sure. I think the NASDAQ, micro NASDAQ E-mini, the micro futures for the NASDAQ, which is the MN. So I'll go ahead and show you it. I don't think there's anything here that's compromising to my account. But anyways, and you can see I'll make like $30, but my risk is $17 from my stop. So my total risk, I don't know, I think I've got $22, $17. So, a little over $30, $35, $36. But, and again, I don't know if the E-mini is one. I think the NASDAQ micro futures it's 1/10 the size. I'll have to double check. But, the main point is obvious. Most people, I don't think, really want to trade Forex if they don't have to. I certainly think it's far easier to trade other markets such as stocks or futures. Futures are really expensive. Stocks, you got to have the pattern day trading rule, which is $25,000. That's obviously not practical for most people. And futures, I was actually talking to TradeStation today, and I believe the minimum requirement for futures is $2,000 in the account. So that's, you must maintain $2,000. And I believe if you're taking a trade in the daytime during the day session, I think the margin requirement's $50. So for, if you just say 2,500, keep it really simple, gives you a little wiggle room. You can easily trade one micro E-mini, and then when you get confident, you can still trade more than one with 2,500 in your account. And that's and also, I believe with Ninja Trader, I talked to them. I don't have a Ninja Trader account though. They mentioned that I think the minimum's like $400 in an account for futures, and same thing, $50 is the margin requirement for one contract. So obviously, and that's really low. I mean, $400 is like you should definitely, if you have $400 in the account, only be trading one and just trying to get practice. But the whole point is the trading costs are not that high, and assuming the volume, which I'll talk about in a second, is strong, it should not be a big deal. And actually, I even asked Al a question about volume in regards to the E-mini futures. And the one thing he mentioned was that he does not believe it's going to be a problem for the simple fact that you have, the CME is really pressing these micro futures. And obviously they're investing a lot into this product. Therefore, there's a lot on the line for them to lose, so to speak, reputation-wise, if they fail to deliver on their promises. And the obvious is simple. If you look at the NASDAQ, if you look at the micro E-minis, if you look at the micro NASDAQ, if you look at the SPY, they all look nearly identical. So to keep it simple, if you look at the SPY and you look at the micro E-mini futures and then you look at the E-mini itself, then you're going to notice they're basically identical. And what that means is, I'm just going to go ahead and get out of this trade here.
Order filled.
And obviously, you're not going to get filled that fast. It's a simulated trade, so the market's just going to automatically fill me because this is not real. But it serves its purpose. Now, if you think about the micros are going to be tightly arbitraged with the E-mini. Therefore, one cannot get that far out of sync. Therefore, I don't see how volume would be an issue, because hypothetically, if someone traded a large number of contracts, if the market was, if this is the E-mini, let's just pretend this is the E-mini. I know it's the NASDAQ, but just pretend it's the micro E-minis. Well, if the E-mini is strong enough break up for a second leg, and hypothetically Trader Bob sells 1,000 micro E-minis, can the market really plunge down while the E-mini is going up? No, because there's computers that are, and even Al said he would do this, there are computers that are waiting for the micro E-minis to get out of sync with the SPY or the E-minis, just as there's computers waiting for the SPY to get out of sync by a tick or two with E-mini. And when that happens, they're going to bet the difference. So if this is the SPY and the E-mini is at, let's just say, or keep it simple, if this is the micro futures and it's at 94, but the E-mini is at 94.50, well, you have computers that will buy this market betting it's going to go up 2 ticks and get back to 94.5. So anyways, I don't think volume is going to be an issue. I have a dog behind me, so he's being a little loud. So sorry for the noise. He's going crazy right now for some odd reason. But anyways, let's talk commission. I talked TradeStation. They have a tiered futures commission platform. So what it means is, for most people, if you trade under 300 contracts in a month, your commission will be 40 cents when you enter and 40 cents when you exit, plus exchange fees of 22 cents. So what that means is, I'll just put on the calculator to make it simple. You're going to have 41 cents Well, actually, I think it's 40 cents when you enter and 40 cents when you exit. So really what you're looking at is 80 cents for trade stations fees. Then you're going to add 20 cents, 22 cents for the exchange fees, and those are across the board. No matter what broker, you're going to pay 22 cents exchange fees. So you're looking at $1.02 round term, which isn't great, but it's not terrible, especially for what you're willing to get. If you're willing to trade Ninja Trader, you can get it down a lot lower. I think you can get down to like 80 cents. And also with TradeStation, the more volume you trade, the less expensive. So hypothetically, a trader could get down to, if they traded large enough, you'd have to trade pretty large, they could get down to 30 cents when you enter and 30 cents when you exit. So it'd be 60 cents plus 22. And the reality is, I mean, let's face it, someone, if they're trading the micro E-minis, they're trying to build a base to eventually trade the E-minis. Now, I agree with Al. Al believes that the E-mini itself will become more institutional and the actual micros will become more of your retail home traders. And the more volume that becomes, I mean, it's simple. The more volume that begins to trade the micro futures, the cheaper they will get. So I do think eventually the commission will get a lot lower. So overall, I think this is a very interesting opportunity for people starting out. The cost is relatively low, and prime example. Well, I'll give you an example of the E-mini today. If you watch the E-mini session, I'm gonna look at the, and you have the daily, you have the Globex charts, and you have the day session charts. So I'm gonna go to the day session, and it works. By the way, it works. Here's the continuous. So I could do the at mes.d, which will give me the continuous contract of the day session for the micro E-minis, or I could type in the actual symbol. But regardless, here's a bar that's 19 to 38. So let's just hypothetically say 18 points. Probably not 18, but probably, I mean, it's close enough. If you were trading the E-mini, you're looking at $900 risk. Well, since you're trading the micro E-mini contracts, that means you're really trading it's really $90 risk, because one micro contract is 1/10 of the E-mini. So I could put my stop all the way down there, risk $19 or $18, and risk 90 cents. Well, and that's a fairly big bar. I mean, that's a big bar on the chart. So you're generally never going to have to risk much more than 18 points. So anyways, it's just I had to pause the video for a second, but I think you get the point. People may find themselves one day, who knows, the micro E-minis may become more popular than the E-mini. There's no telling, but it wouldn't surprise me. So this is just a really interesting time and opportunity for people interested in trying to figure out trading. It just really allows people to get in the game, so to speak, with not a huge amount of capital. So, and that's really all I've got for you. So I hope this video is helpful. I guess I might as well, I'll talk about the day. So I will be, for the most part, until I discover, who knows, I may try and trade the micros live and discover that the volume's too low. I don't think it will be, though. I don't at all. So And I mean, another thing I like about the E-mini versus the SPY is it's just, I like the whole fact that when I'm looking at the E-mini, it's points. So 4 ticks is 1 point, which is the minimum scalp instead of 10 ticks. It's just easier to, you have less false breakouts. And what I mean by that is, I don't know, it's just, try and find one real quick. It's kind of hard, but they're there. Such as, like right here. You have a low one short, never triggered, but maybe it triggered on the SPY. Or, here's a good example. You have a bad stop entry buy, but maybe it triggered on the SPY, since the SPY's, one tick in the E-mini is about 2.5 ticks in the SPY, because 2.5 times 4 gives you 10, which is 10 ticks minimum scalp size and 4 ticks minimum scalp size for the E-mini. So I'm going to be discussing a lot more in terms of the E-mini. So anyways, coming into the day, gap down, broke below yesterday's range, tried to reverse, pulled back again, tried to reverse. 20% chance this is the low of the day, so which means you'll probably get an opening reversal. We tried, and then we quickly found this big bull bar. I believe TradeStation had bad data. That's what Al said, because the bar when I was watching it was all over the place, and it was like 5 minutes behind. And if you're ever in that situation, if your data is 5 minutes behind, you're better off just getting out. If you're in it, especially, I would just get out. You don't know what's going on. You don't know if you're ahead or if the price is right, and you can get out and minimize the chance of something you don't want happening, and wait for the bars to catch up. Because I think right here, you just don't want something bad happening. But anyways, sorry, it's my dog. Big bull bar, dominant bar, probably going higher for at least several legs. No reason to sell, very tight channel, first time to fail, 5 consecutive bull bars, 6 consecutive bull bars. Minor reversal down, probably going a little bit higher, very tight channel. So not enough bars up, not enough bars down, not enough bars up for a major trend reversal, probably minor, and then we got a few legs down. Gap bar, probably going to retest these highs. Had a little bit of a surprise bar over here. Probably going a little bit higher, but bad follow through all the way up, so not really by the close. Then you got a big bear breakout, and 50% pullback, closing these gaps, or at least close this gap, and forming a trading range really for the rest of the day. So nothing really all that special. Often when you get these strong moves that kind of do this real quick on the open, you go a long way in a short period of time. You often just go sideways for the rest of the day. Sorry about that. Good boy, buddy. So anyways, that's all I'm really going to say. Mainly this video is going to be about the micro E-minis, which I think are a very big thing for traders, and they're going to find that I think the volume is going to increase rather quickly, especially with the E-mini. And who knows, maybe this leads to, I'm sure there's a micro contract for crude oil somewhere. I know there's one for gold, and maybe that one will increase in volume because of this. One thing I think that's going to happen is, I don't know when, maybe 5 years from now, I think the pattern day trading rule will go away. There's just, if you think about it, the big thing about this is the CME group, Chicago Mercantile Exchange, has decided to make it very easy, or more easy, for traders to trade without a lot of capital. So, and they don't have a barrier to entry. So I think eventually you're going to see that with stocks. You're going to see the SEC, Securities and Exchange Commission, which I would assume It's the one that governs the pattern day trading rule in the US. If you live in the US, you will begin to see that go away. At some point they're going to say, well, hey, there's no point in having it, and which will create even more opportunity. So I really think this is huge for most people. I truly do. One day you may see, you may have the ability to day trade stocks with $1,000. Now, the one problem you're going to have with that, I do see, is, for example, with TradeStation's minimum commission on stocks is $1 in and $1 out. So if you want to keep it real simple, it's in general, it's a minimum of $1. So if you trade 100 shares, really it's 1 penny per share. However, it's a minimum of $1. So if I trade 100 shares, I'm going to pay $1 when I enter, $1 when I exit. If I trade 101 shares, I'm going to pay $1 and 1 penny when I enter and $1 and 1 penny when I exit. So if I trade 150 shares, I'll pay $1.50 when I enter, $1.50 when I exit. That will be the one problem for some traders with stocks. You're going to find that it won't be practical for people to trade 10 cents of Apple, because they'd have to make, I think they'd have to make 10 cents. If they trade 10 shares of Apple, I think they'd have to make 10 cents just to break even. So it won't be practical. But it'll certainly make trading stocks easier. So who knows? That's all down the road, and I'm kind of rambling now. But at the end of the day, this is just really, really huge for a lot of traders. And there's nothing else to really say about it, And look right here. So hypothetically, let's take what I did. Let's examine it a little bit. I said we were probably going to close this gap. Why did I say that? Well, my first inclination is simple. My first reason is simple. Went below the slow, turned up. Went below the slow, turned up. And my next one is this. Very strong rally. Really started an obvious pullback here, so maybe just testing the pullback. We've been going down for several legs. And this is a very strong second leg down. So when you have a very strong second leg down, usually you get a strong enough breakout for a second leg. But what is it? Is it a bear trend or is it a trading range? Well, when you look at this, you say, wow, what a strong bear trend. But when you say, hey, wait a minute, we're breaking new lows, getting bad follow through. We're breaking again below, getting bad follow through. So the reason I bought here, I would have bought above this bar. I was a little late. I didn't see it till over here. Always in bears get out. They have their second leg. We have a small kind of low too short, but always in bears get out and expect 2 legs up. And a couple reasons. You have bulls that bought this low, and they'll use a really wide stop, maybe a measured move down of this entire range, maybe. And they'll keep their stop, somewhere down here, and they'll look to add on more lower. And you also have bulls, getting out on this bar, and they want to buy again. So my first target, quote unquote, was here. However, because I was talking to y'all, and I really just, it's not real. It's just, I'm just kind of testing out the waters, trying to figure out the commission with TradeStation, and just kind of see if I like it. And I do so far. Strong enough breakout for a second leg. Here's our second leg. But look what we have. We have a very strong bull bar. We're above the target here, this high, maybe this high. We're still forming a lower high, so kind of parabolic. 1, 2, 3. I think we'll get down to here. Now, my problem with selling below this bar is it's rather big. I think the target's here, so if I sell here, put my stop up, really only gives me 1 times my risk. And I think, what I think is more likely is we're going to trade down for 10 bars, 2 legs, form a stop entry, maybe down here, and retest this high. So I think that the bulls who bought this close are disappointed, and the smart ones, well, the smart ones didn't buy the close because it's the strongest bull bar in a, rather big down, big up situation. And we've had a wedge top here, here, and here, and they're gonna say, "Gee, that's strong. I wonder, will the bulls be strong again down here?" So I'm not gonna buy this. I'll look to buy lower. You have bears they're waiting to sell, and they say, "Okay, finally, we closed the gap, went above these highs. We're getting on strength. I'm gonna sell this close, betting we'll at least test down here before we go much higher. And if we get a second bull bar, I'll exit." Well, they didn't get their second bull bar. So the difficult thing about buying this close is, where's your stop? Well, ideally you can put a stop below a breakout. Same thing with, if I buy this close, I can put the stop below this breakout. However, this is exhaustion, so it may fall below it and turn right back up. So it's not that simple of a stop entry buy, or it's not that simple to buy the close, because you really need your stop down here, and that's a lot of risk. So think about it. And another problem is you got to think from the perspective of a 15-minute chart. Well, I think we'll get a second leg down. However, this is a very tight channel, so I think we're going to retest this close. And 60-minute chart, well, very tight channel, probably get a second leg down, which I do agree. But anyways, I don't want to I really don't want to talk about different time frames at this moment. So I think a lot of always in bears will get out, always in bulls will get out below the prior bar and wait for a few legs down. But as you can see, there's a trade. A trader could have sold this bar, they could have sold this close, they could have sold this. If they sold this close right here at 91, I think a minimum scalp, I don't know, 80. I think it'd be, well, the close is 80. It is 91. And I think the minimum scalp's, 81. So 10 points. Sounds reasonable to me. I think that'd be right. Just out of curiosity, what did I get? If I bought at 88, I got out at 96, so a little under 10 points, but that's okay. So if they sold this close 91, they could have gotten out at 81, which makes sense. So traders sold, they scalped out at 10 cents, we bounced. Kind of a stop entry short. I wouldn't take it, but probably went about 86 to, I went a little more than 10 cents down. So I hope this video was helpful. Comment below if you have any questions, and I'll be happy to answer them. Thanks.